Hey, Mike Swanson. I want to give you a quick overview of what I think is going on in the stock market. As you know, the S&P 500 and the U.S. stock market averages have been in a correction since the beginning of August. And yesterday, they dipped below the support level that had been formed since August and came back on the close. And markets across the world, for the most part, have been much weaker than the U.S. stock market. And that's because of the debt crisis now going on in Europe, where people are focused on Greece and the likelihood of a default there. And my contention is we're likely to see some sort of temporary bailout for Greece that holds off a default until sometime next year. So what I'm suggesting is that once we get some sort of what I'm calling a bailout band-aid to help Greece over for a couple months, we'll probably see the stock market finally put on some type of rally. But again, I want to emphasize the fact that markets are falling everywhere. And for example, this chart right here is an ETF for the emerging markets. Those are markets in Latin America, Brazil, Chile, and Asia. And these in China too. And these typically have been the hottest stock markets of the past 10 years that in fact tend to lead the U.S. market. Back in 2009, when the bear market in the United States was making new lows in its final low, these markets held up and then led the whole world higher for the year afterwards. In fact, this year they were outperforming everything until July, and then they just crumbled. And European markets, of course, are in terrible shape. In fact, as our market held up, our market corrected in July and held up its August lows. Markets in Europe, and this is Germany, slipped below their August lows and performed much worse than the U.S. market has. Now, what's going on is people are just like sitting around, they're dumping stocks on bad news, which seems to come on a daily basis, whether it's signs that the economy in the United States is weakening, or more troubling news about Greece and economic woes in Europe. And the real problem of Greece isn't just, Greece is a small country. The real problem is the danger that Greece will default, and then people worry about Italy and Spain defaulting. And those are big countries. And of course, the banks over there in Europe are leveraged to the hilt on this government debt of these countries. Just like the U.S. banks and the banks over there too, we're all leveraged up on mortgages that led to the 2008 financial crisis. So there's a lot of fear that something similar to that can happen. It's not as clear-cut clear that that's going to happen, but I think in the end we're going to see some sort of temporary bailout package for Greece that will help hold things together here for a couple months, and then next year Greece will finally default, and we'll have the final stage of this crisis going on, and that'll mark a final end to what we're really seeing. But I think we can get a good rally before then. And yesterday, this is a 60-minute chart for the past 2 weeks or so of the S&P 500. You see we got a nice little bounce from 1120 back up to near 1200 the other week. And then since then, it's just been a downward slide until yesterday. The market rallied for a few minutes on the close. I mean, it was a big rally based on rumors that some sort of bailout band-aid was going to occur, was being put together for Europe. Now, the thing is, Greece, according to all reports, has about the middle of next month before it's going to go completely bankrupt. And like I'm saying, between now and then, I suspect we're going to see a bailout package that'll help keep that country together. Now, let's put all this stuff in context of long-term trends. And to identify the long-term trend of the market, I look at long-term moving averages, and you break the market down. This is the 200 or 150-day moving average I use, and I'll show you, we'll apply it together. But we can break the market down into a bull market, stage 2, stage 3 is a topping phase, stage 4 is a bear market, and stage 1 is what comes after bear markets, where you get a sideways phase. So, it appears like we're somewhere up in here. Well, actually, we slipped down as you'll see, the U.S. stock market is now below its long-term moving averages, which are outlined right here. And in the last bear market, from 2007 to 2009, you can see how once the market got below those moving averages, it was just a nightmare. Same thing happened from 2000 to 2003. And then during the bull markets, these moving averages tend to act as support, as you can see right here. But we're not in that type of thing anymore. You know, from 2009 till this summer, basically the moving averages were acting as support. Now we've been below them for almost 8 full weeks. And that's bad. Now that doesn't necessarily have to mean that the market's going to fall like it did in those last 2 bear markets. I know a lot of people think that's the case, but it really isn't. We could see the market bottom out here and then go back up to 1,300 even, or 1,200 or whatever, and just go sideways. In fact, we'll examine that possibility in much greater detail once we do get a bottom. That's been the pattern of what you see in many secular bear markets. It's happened in the United States in the late 70s, in the early 40s, late 30s, after World War I, and so forth. And I think something like that is likely to occur. But the important point that you've got to take away from this is that because the U.S., well, basically every market in the world, is now below its long-term moving averages, the upside potential is extremely limited. There's almost no need to take positions here that you would plan on holding for 6 months, a year, or longer until this funk is really over with, until the European debt crisis really passes. And I don't think that's going to really occur to Greek defaults finally, probably next year. So the upside potential is really limited. This isn't a market for buying and loading up stocks and, you know, for the long term and so forth. This is a trader's market, and if you're not a trader, I really wouldn't mess with it. I just sit back and watch things unfold and think, well, you know, next year sometime I'm going to take some long-term positions. Until then, I'm going to be patient, and that's the way I think you should think about things. Now, for the short term, I want to talk about one plus the market does have going for it, and that's there's widespread negative sentiment among investors. And that's important from a contrarian standpoint, because normally in bull markets, once everyone gets all bullish, it means everyone's bought and loaded up on stocks. There's no one left to buy, and that's negative. And the opposite in bear markets. When everyone's bearish, it means people have sold. They've said, now I'm a bear, I've sold, I don't believe in the market anymore. And then there's no one left to sell, and the market holds up and turns around. So according to today's Investors Intelligence Survey, the number of people bearish in the market is 45.2%. And that's a huge, huge, huge number of bears. Most of this year, the number has stood around 25%. It's gone up dramatically. Now, the number of bulls has shrunk, too, to 34.4%. That means there's more people bearish than bullish on the stock market, which historically is a fairly rare occurrence. In fact, the last time there were this many bears was way back in March 2009 at the very end of the last bear market. So no one believes in the market anymore, and many are expecting a huge crash or big declines and all this kind of business. Well, in my opinion, more likely we're going to see the market get a footing here and then rally and then go sideways in a wide range for a year. But again, we'll talk about those type of scenarios once we finally do see an end to the current funk that we're in that started in August. And I think it'll end once we get, like I'm saying, a good a bailout band-aid from the European banks, the IMF. Once that happens, that worry will be lifted from the market for a period of time, and I think we can see the market have a sharp rally and hold together here for several months. But then at some point afterwards, I would still expect Greece to default on its debts. Then we'll have to sit back and we'll have to see How bad is the debt situation for real in Italy and Spain? Is it going to spread? If so, that occurrence would probably occur over a very short time period. Think back, if you've been in this game for a long time, to the Asian debt crisis in 1997, or what happened with the Russian crisis in 1998. Those are the kind of models I'm looking at. Not like this is some horrible permanent thing that's going to screw everything up forever, but just the funk that we're in, that once it comes to pass, we can see some good long-term buy points in stocks. Anyway, so that's what I'm looking at. In short, I'm looking for the market to finally end the current funk we've been in August, since once we get some sort of a bailout for Greece, and then a rally, and then a default next year, and an end where we can really take some long-term buy positions. Until then, it's a tough market. It's a trader's market. Once we get some sort of rally, traders can play that, but they'll have to be willing to jump off the train. And investors, frankly, should just sit on the sidelines and wait until this crisis really plays out and comes to a final end, which won't really happen probably till next year. So anyway, we'll be talking to you later.